Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Renewable Energy Opportunities for Agribusiness. We're pleased that you've joined us today, and before we begin, I'm going to play our housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, today we have with us Matt Kaden, Managing Director here at Moss Adams. Matt has special expertise in the federal income tax of flow-through entities and is the industry leader in the structuring and taxation of energy transactions. In his previous role at North America's largest developer of renewable energy, Matt was responsible for the structuring and tax advantage financing of over $10 billion in renewable energy and decarbonization projects via tax equity and private equity, and many more through a public equity and debt raises. His contact information is located in your webcast console. And now I would like to turn it over to Matt to get the presentation started.
Thanks very much, Amy, and good morning to most of you, I think, probably on the West Coast, and good afternoon to our friends on the East Coast. I think I'm going to advance past that picture. Here are the learning objectives. Identify how renewable energy ties into agribusiness and how your clients can benefit from sourcing and developing renewable power generation, solar, wind, renewable natural gas. We'll do an overview of the tax and incentives available and explain how one would qualify for those credits and incentives. Again, focusing mostly on the Inflation Reduction Act, which was enacted in 2022. I'm not sure whether it's actually reducing inflation at all, but probably just happenstance that has come down a little bit after it was enacted. Quick agenda, big picture. So again, Inflation Reduction Act, this was to date, probably the largest investment in combating climate change through domestic energy production and manufacturing initiatives. The Congressional Budget Office scored these provisions at $400 billion over 10 years, but a lot of analyst estimates are a lot higher than that. Many are sort of around the $1 trillion mark, sort of cost to the fisc over the 10 years. So this is a very significant investment that we're all making in this stuff. And, it's not just to combat climate change, although that's a big part of it. So I think of it as sort of three goals. Number one is sort of that, which is accelerating the transition away from fossil fuels. But also there's a number of provisions, and we'll sort of allude or talk about some of them, that are aimed at domesticating certain parts of the renewable supply chain. In particular, a lot of that supply chain, almost all of it actually, is located offshore, and particularly in Asia, and particularly in China. And so obviously this administration, like the previous one, sort of aiming at China and sort of bringing manufacturing back to the United States to some extent. Kind of goes along with that is just, not relying on foreign sources of energy. So obviously everyone's aware of the situation in Ukraine, and it's not, and Europe during the panic of sort of the last winter. Folks don't want to replicate that here. So, one of the initiatives or one of the goals here is to enhance energy security for everybody. I'm assuming everyone can hear me. I'm going to see one comment that's no audio. That's probably on your end. So the mechanism by which these goals are to be fulfilled is basically a lot of tax credits, both the expansion of existing credits, so credits that already exist under the tax code, but they were made longer lasting. They were supposed to phase down starting this year, some starting last year, but they're actually continued at sort of full amount for at least the next 10 years. And then also expanded the amount of a number of these credits. And so where the incentives to sort of build these facilities were not great enough, the cost was not low enough before, the idea is that now with these further incentives, that these will make economic sense to build. And then it also adds a number of new credits, which we'll mention. So what's the sort of impact on the climate or the emissions? There's a lot of estimates out there. I think that this is kind of starting to form a consensus around this type of number here, which is 31 to 44% below 2005 levels. And it's in a chart on the left, your left. So the blue shaded piece, so actually starting on the left, you can see that in 2005, there was about 6.5 billion metric tons of CO2 emitted in that year. And, sort of been coming down gradually since 2005. Renewables play a part in that, sort of cleaner, switching to sort of more natural gas in the energy mix has helped that. But you see the blue shaded area, that's kind of without the Inflation Reduction Act provisions. And so they were thinking maybe 24 to 35% reduction overall since 2005 in emissions. With the Inflation Reduction Act is the orange shaded piece. So you're getting 10 percentage points or 30%, 25 to 30% increase in emissions reductions, which is obviously great. But you look down and that little gray line is the US Paris Accord 2030 target, which is 50 to 52% below 2005 levels. So this is not expected to sort of meet that target. And so certain folks will probably be pushing for more incentives in the future. Other folks will probably push back. On the right is an interesting chart. It's sort of, it's the all-in cost at sort of a present value per megawatt hour basis of energy for different technologies. And so the idea here is, well, what's the most efficient from a cost perspective? And the light blue is sort of pre-Inflation Reduction Act. And you can see that even pre-Inflation Reduction Act, wind and solar, if you compare it to gas at the bottom, actually, cheaper to build and operate than natural gas before the Inflation Reduction Act. Some of the other technologies below are still quite a bit more expensive than gas, but the dark blue shows the Inflation Reduction Act impact, and obviously dramatically moves wind and solar far to the left of gas, cheaper. Battery storage now kind of coming within the realm of gas, and even hydrogen, which was extremely prohibitively expensive, is now kind of going to be competing with gas probably in the next 5 years. And then carbon capture there as well. So the point here is just that this kind of trend was already happening, and the Inflation Reduction Act is kind of accelerating. So we do a lot of deals, a lot of advising developers, investors in this space, and quite frankly, very impressed with the response to these provisions. Major investments in renewables by new players, many from abroad, including Europe and Asia, looking to make very large investments in the billions in renewables, in domestic manufacturing, so foreign manufacturers, relocating or putting a U.S. branch in to build components for renewables. So again, taking advantage of some of the incentives related to manufacturing. Not going to get too much into that today. It doesn't really impact most of the audience, but there are large incentives for manufacturing now, these types of components. So seeing very large investments there, as well as carbon capture. So this is basically, putting a new facility onto a ethanol plant, for example, that generates CO2. I say ethanol because it's particularly easy to sort of capture and pull out the carbon oxides. But you basically put that equipment on. It's quite expensive, but there's significant credits for that. And you capture the carbon oxides, you sequester them, and you're entitled to large credits. And so the big oil and gas majors particularly are investing heavily in that. There's, some good news on sort of demand for workers and wages. Definitely seeing that across the economy for construction, but in particular for these types of projects, there's provisions that we'll talk about requiring or tying the credit amount to sort of paying your workers prevailing wages. And not just sort of your workers, but anyone that's working on the projects. So that's seeing an uptick in demand there. And then the incentives are sort of not going to one particular party. It's kind of being shared at this point. So there's, developers are getting some of the incentives, but they're passing a lot through to, end users. Manufacturers are capturing some of the benefits, through that are available. So really it's being shared through the value chain. And, there's some headwinds that are kind of limiting the impact of this act, sort of that are helping prevent reaching those Paris targets. One is there's been a lot in the news about this, but the permitting process for connecting, sort of getting in line with other folks at different interconnection points is very backlogged, and the process is very inefficient. And so projects that could be built in, say, 2023 can't be sort of put on the grid until 2025. And so that's slowing this transition. Other thing is offshore wind. This is those huge things, 500 feet tall, that sit in the ocean. very expensive, obviously, to do that, very complicated from an engineering perspective. And we're finding that insurance is very difficult to obtain, as you could imagine, given sort of the complexity of that type of facility. And then, demand for EVs and charging infrastructure, I think, is very strong. But the problem is that there are pretty significant resource constraints. The transportation sector is about a third, or accounts for about a third of emissions in the U.S. And so, the inability to sort of source lithium and nickel and different things to make batteries for electric vehicles is sort of putting a brake, I guess, no pun intended, on the electrification of that sector. So a lot of words here, but the point of the slide is just to say that everyone can participate in the IRA. So, do you own a business that uses energy? I think many of you do, or associated with such businesses. There's just a number of incentives to source your own energy, to generate it, to sort of reduce your power costs, while at the same time sort of getting incentives for reducing your CapEx. To the oil and gas, industrial, talked about the manufacturing, we talked about the carbon capture. Oil and gas is also going to get into hydrogen production, which is going to be a big deal in the next 5 to 10 years. And then some folks just want to reduce their tax liability. I put myself in that category. And so, there's the ability now under the Inflation Reduction Act for someone other than the party generating the credits to use them. And the mechanism is through a sale. So this is kind of the first time that this has been allowed under the Internal Revenue Code. You can sell your credits to buyers, or corporate buyers or other buyers who have tax liability, or if you have taxable income, a lot of corporate clients in particular are coming to us looking for sort of renewable projects that they can buy the credits from. So many people participating in that market, and that market is going to get very large, we expect, perhaps even sort of trading on some sort of exchange. But as of now, it's kind of, you need sort of a party to put the buyers and sellers together. And then the last quadrant there is, do you run a nonprofit? Well, many of you are associated with nonprofits or know people that do run a nonprofit. And the big thing there is that nobody's ever thought about tax credits that are nonprofit because they don't really have taxes. So the Inflation Reduction Act allows a nonprofit to participate and receive a cash payment from the government in lieu of sort of reducing their tax liability. So that's a pretty big deal, and we're seeing a lot of nonprofits and other tax-exempt entities participate in that. Just sort of touching on, what sectors we're talking about. We're going to focus mostly on the upper left quadrant, renewable electricity and infrastructure, particularly solar, some wind, geothermal, and natural gas. The other sectors are sort of described here. There's a commercial electric vehicles credit, which may impact some of you, EV charging. But for the most part, we're going to focus on the upper left quadrant. So, we're seeing agribusinesses participate in a few different ways. I would say one is sort of using, and we're seeing this with not just agribusiness, but a lot of clients, using solar or wind, or solar and or wind with battery storage to power, operations, whatever sort of plant or business it is. just as a way of sort of reducing power costs, while at the same time take advantage of these incentives. The other way we're seeing folks participate is either co-locating a renewable natural gas facility, such as an anaerobic digester, which sort of takes food processing waste or manure or other sort of animal byproducts and converts to sort of clean natural gas. So we're seeing farms and other businesses co-locate those facilities and actually work with a developer or develop those facilities on site, and then sort of selling the gas that's produced into the market along with other products, which we'll talk about. But also, we're also seeing folks that are just providing the feedstock for that facility, whether it's, again, food byproducts or blood or manure or dairy byproducts. So that's another way we're seeing people participate. On the RNG side, you could get up to a 50% investment tax credit. We'll talk about sort of how that's calculated, but the thought of sort of getting 50% of your CapEx back immediately is pretty attractive. On the solar side, it could potentially be higher than that, just because of some of the special rules. They're called the environmental justice rules, but they're applicable to solar and wind. And in that case, it could rise to 70% ITC. The other option instead of the ITC is the PTC, and we'll talk about what these terms mean. But that's also an option, especially after 2024. So just some tax credit basics, just to ground ourselves a bit here. Two general types of tax credits in the federal code that relate to energy. One is an investment tax credit, which is basically, as it sounds, based on your investment or the cost of the eligible property. A lot of these projects there may be some time between investment and actually operating. The credit is sort of earned when the project starts operating. So there can be sort of a lag between investors putting their money in and sort of this credit being generated. There's a recapture concept with investment tax credits. So it effectively vests over 5 years. If there's a disposition, if there's a sale, if the project is destroyed and can't be rebuilt, all of that sort of creates this recapture risk that is sort of unique to the ITC. Have to be careful about ownership with it. It can be sort of subject to reduction for tax exempt ownership. And then it can be owned and operated by different parties. You could have one party own it, another could lease it. And so there's flexibility there that's not there on the production tax credit side. So on the production tax credits, obviously that's based on production or production and sale generally of a manufactured product. It's a 10-year strip for the most part. And the sales have to be to unrelated parties until 2025, which we'll talk about. There's no recapture concept. There's no sort of tax exempt restrictions, and there can't be a lease of the equipment. It sort of has to be owned and operated by one party. And there is a carry back and carry forward concept for all of these credits. They can't be used or sold to a party with tax capacity. They can be carried back for 3 years and then carried forward for 22 years. So I mentioned before that, talking about seeing a lot of corporate buyers, we're also talking to a number of funds that have been created to kind of have individuals participate in the sort of tax credit market. So, this is where they'd be seeking to purchase tax credits from these projects. And one of the issues just to be aware of throughout this presentation is that there are some complicated rules called the passive activity and at-risk rules that limit the ability of individuals, estates, trusts, and even closely held corporations. I believe that's sort of 5 or less owners in shorthand that can use the credits. So basically the credit gets generated, but then there's a analysis that needs to be done sort of up at the partner level or shareholder level to determine to what extent the partners or shareholders can use the credits. And so that needs to be sort of addressed if you're either developing a project or just investing in tax credits. The at-risk rules, they're really designed to sort of allow credits only to the extent you're economically at risk. So to the extent there's non-recourse debt in the structure, that can reduce one's ability to use the credits. Passive activity, basically an individual could use the credits under these rules if they have other sources of passive income, which is essentially K1 income. It doesn't include dividends or interest, things like that, portfolio type income. So you could either use these credits to offset other passive income, or you could what's called materially participate in the activity that's generating the credits. And there are different ways to do that. You know, some folks that we deal with, they take advantage of what's called the 100-hour rule, which is if you're participating 100 hours in, say, the development of a solar project or in the construction, you're supervising it, whatever the case may be, and you're spending more than any other person on that activity in that year, then you could potentially materially participate, and those passive activity rules would not apply. So those are complicated rules. Talked about this a little bit, the tax exempt use property. Just you need to be aware if you have particularly if there's an investment fund. A lot of investment funds have tax exempt partners, and that can impact the ITC owner, the ITC amount. It can actually reduce it in proportion to that ownership. And so have to be really careful in a fund structure, sort of how it's set up with tax exempts. And now I'm going to pass it over to Amy for our first polling question. Amy?
All right, thank you, Matt. So the first polling question is, a farm owned by a private equity group installs a solar facility to power its operations. How long does the PE group have to wait to sell the farm to avoid recapture of the ITC? And then your options are 1 year, 5 years, 10 years, or none of the above. And for those of you looking for the polling questions, they are located right on the slides that we're presenting. And if you can't see it, you can hit the F5 key to refresh your console. And then also remember to hit that submit button once you select your answer. All right, Matt, it looks like most have responded, so here are the results.
Yeah, it's 5 years. The credit sort of vests over 5 years. So if you sell the project, or the PE fund sells the project after 4 years, it would lose 20%. If it sells it after 3 years, it would lose 40%, and so on. But yeah, 5 years, you would not have any recapture amount. So we'll get started with the investment tax credit. This is going to be probably the main tax credit, at least until 2025 on the types of projects that we generally see in this business. Beautiful picture of solar panels and an oil pump there in the back. So to the particulars, the ITC is on qualifying energy property. We'll talk what that is. It's generally 30% of the basis, so 30% of the cost that's placed in service during a taxable year. And that 30% ITC, it depends on satisfying those wage and apprenticeship requirements I mentioned, which are sort of a big part of, Manchin was kind of holding up the IRA for a while. And this is one of the provisions that he thought was important to make sure people are paid sort of a prevailing wage. And also that there's certain apprenticeship requirements being complied with. Talk about those a little bit later. But without those being met, the credit reverts to 6%. So pretty much everyone is complying with those rules or trying to, because it's, 80% of the credit value is tied up in those. So you can figure if you satisfy those rules, you're at 30% to start. So $100 million project, $30 million tax credit. Obviously, not all property is qualifying. Land is not qualifying, but most of the property that goes into these facilities does qualify. So most of your cost is going to be tax credit eligible. There are additional bonus components that we talked about. You could get up to 70% ITC on some solar and wind projects. So effectively, the way that works is you've got bonus credits for domestic content. So this is the sort of domestication of the supply chain to the extent you're using products that are made in USA. You get a 10% percentage increase. So your 30% ITC, $30 million ITC goes to $40 million. Energy community, this is broader than it may sound. It's basically anywhere that had a very small amount of fossil fuel employment. And then the unemployment is below the national average. So quite a few communities, particularly rural communities, satisfy those requirements. And so we're seeing the energy community sort of 10% bonus come up in a lot of projects. And then for solar and wind facilities that are less than 5 megawatts, so these are pretty small, but could be the size that would be on a rooftop or on one's property. These could qualify for an additional 10 percentage points if located in a low income area or on tribal lands. And then to the extent you're involved in a low income residential building project is probably not too relevant here, or a low income economic benefit project, that would be a 20% adder. So you could have up to 70% potentially. And there's that example. So what types of property we're talking about? Here's a list, but for the most part, we see a lot of solar. Wind is generally for larger. It's a little bit more complicated just from an engineering standpoint, and it's obviously expensive. So generally, for smaller facilities, we see more solar. Often paired with energy storage because the sun doesn't shine at night. And then another thing we're seeing a lot of is qualified biogas property, which is otherwise known as renewable natural gas or RNG. We're seeing a lot of that in particular because it's a new addition, as is energy storage actually, to the ITC. So now you can just have an energy storage facility. It could be connected to the grid. It doesn't have to be connected to anything renewable. But that also, the cost on that also qualifies for ITC. And then the RNG, starting with the Inflation Reduction Act, starting now, is also ITC property, which it never was before. So a lot of projects that maybe didn't quite make sense. Now they do make sense with the ITC. And so we're seeing a ton, particularly in the agribusiness sector, of RNG projects. So kind of some tax stuff here. Have to do this real quick. The ITC, to be eligible property, has to be depreciable. So that kind of goes to the land not being eligible. there are some rules around, a lot of rules actually, around when construction begins, because it sort of impacts the energy community bonus credit. It impacts whether you have to comply with the wage and apprenticeship rules. So you could be using equipment that was purchased prior to January 23, and those rules would not apply to you if sort of purchasing that equipment qualifies as beginning construction under these rules. So it is relevant sort of when construction begins. It has to be in the U.S. And then, the ITC has this flexibility where the lessor or the lessee can sort of claim the ITC. And then the 5-year recapture and the transferable credits as well is a new feature of the IRA. So just some basic structures here with solar. You could have an entity that just owns the facility directly. It gets the credits, the tax credits, the ITC. To the extent the farm is held in a flow-through structure, you have to sort of look at those passive activity loss and at-risk rules. And then to the extent you have more energy than the business can use, you can sell the excess to the grid in many states or receive a bill credit. You also get tax depreciation and renewable energy certificates, which are tradable and can help off-takers satisfy their sort of ESG requirements or their sort of state-mandated renewable portfolio standards. So a lot of different sort of revenue streams and value streams with these projects. And there's 4 listed there. So now we're sort of adding the credit transfer piece. So this could be where your business either doesn't have taxable income or has taxable income, but is sort of limited. The owners are limited in their use of the credits by the passive activity rules or the at-risk rules. So basically what you would do here is you can't do anything about the tax appreciation. You kind of have to take that and use it or carry it forward. You still have the RECs in the structure. You could sell it to the buyer of the tax credits, or you could sell it to a third party. But here we have the project selling the tax credits to a buyer. We're seeing anything from 80 cents to 95 cents on the dollar. The sort of higher end of the range is where the business that's selling the credits would be like a credit-worthy entity that is guaranteeing the credits qualifying the project qualifying for credits would guarantee those credits being available at the particular percentage that is represented. And so the lower end of that scale, 80, 85 cents, that's for projects that, don't have a sort of guarantee from a creditworthy entity. They are relying on tax insurance generally. That's generally sort of the range of outcomes we're seeing. A little bit different. You could actually, have another party own the facility and sort of lease to your business. In that case, the farm in this case is getting ITC. There's an election for the lessee to take the ITC. And then this needs to be confirmed in regulations, but we're expecting that the lessee would then be able to sell the credits to a third-party buyer if they couldn't use them. In this example, the asset owner takes the depreciation. The other big category we're seeing in this in your industry is RNG. And it does not qualify for production tax credits. We'll talk a little bit about solar qualifying for production tax credits, but RNG is strictly for ITC. So here's, just a graphic. Organic material, it's delivered to the anaerobic digester. The material is broken down into solids or liquids, and the biogas, renewable natural gas, is separated out and sort of converted or processed into clean natural gas. And then usually that clean natural gas is shipped away, and either a buyer is going to use the natural gas, or it's going to be injected into a node, into the grid, and so it's going to be monetized that way. And we'll talk about some of the other value streams here. So you have the business that owns this renewable natural gas facility or anaerobic digester. So you kind of have a dry type of digester that is basically taking material from feedlots. Then you have sort of a wet, it's getting a little bit gross, but you have a sort of wet concept as well, which is the sort of dairy type byproducts and other food processing, slaughterhouse type byproducts. So there's different digesters for different feedstock, but the idea is that you're taking that and sort of converting it to energy and not just wasting it. So again, you can get up to 50% ITC on CapEx, and then these credits also qualify to be sold to third parties. And they also come with additional streams of revenue, which are, in addition to selling the gas, renewable energy certificates. Those are more applicable to electricity, but the gas is the renewable identification numbers, which help satisfy national renewable fuel standards and California low carbon fuel source standards. So those have pretty significant value as well. And in this case, only the tax depreciation, or if the RNG is used for some reason on site, we don't really see this, but could also generate electricity for the business. But for the most part, they're selling the gas to third parties and then selling the credits. Production tax credits, there's a picture of wind farm here because until 2023, this was only associated with wind and wasn't associated with solar. That's changing. So won't get too much into this, but generally most facilities, if you just look at the project level economics, the production tax credit will be more valuable. Again, this doesn't apply to RNG. It's solar, wind, some other technologies, but sort of the 10 years of renewable generation at $27.50 a megawatt hour adjusted for inflation, generally, in most cases, unless it's a very low resource situation, meaning that there's not a lot of sun. For example, you're in Seattle or Vermont, the ITC may be better because you're not going to produce a lot of electricity. But for the most part, PTC is more economical. It just, it's a little bit harder to do right now because you have to sell to a third party. And so a lot of folks that are looking at smaller facilities to sort of to power their own operations can't take advantage of them until 2025, which we'll talk about. Again, it's a 10-year period. There are the bonus credits, the same bonus credits we talked about earlier, but it's 10%. So it's not 10 percentage points. It's instead of 2750, it would be 2750 plus 275. That would be the 10% bonus credit. And again, you can sort of elect for all of these now, ITC or PTC. Here's a list of the technologies that qualify for PTCs. So the big requirement that's sort of special to the PTC is it has to be sold to an unrelated person. As part of that, you can sort of have a middleman that's related, but ultimately the end user has to be unrelated. Electricity has to be produced in the United States, and there can't be any leasing of the facility. It has to be owned and operated by the same party. One of the big things with PTCs is that you can retrofit the facilities after 10 years or repower them, where you're basically replacing some components, but not all. And so you're basically, when you do that and you satisfy the IRS rules, you get another 10 years of production tax credits, even though your CapEx for that repower is going to be less because you're not doing like a full rebuild. So that's an opportunity that a lot of folks are taking advantage of. The last bullet is just that, most of these tax credits, if they're owned by a tax exempt entity, they can just get a cash payment. They don't have to sell the credits or use them against tax liability, which they don't have. They can just elect to receive a cash payment. So that's pretty nice. So this is what I was talking about, where PTCs kind of, it changes after 2024. And so a lot of projects that would be ITC maybe will be PTC after that point, that are sort of placed in service after that December 31st, 2024 date, because the requirement of selling to a third party goes away. And so as long as you have a third party that's metering and sort of verifying what's being generated, you can claim the PTCs in lieu of the ITC. And there's a phase out that's tied to sort of emissions in the power sector in the U.S., which is that second to last bullet. But that's not for a while. It's not going to be in the phase out at least until 2034. And Amy, I think we have another polling question.
All right, thank you, Matt. So the second polling question is, a taxpayer is using on-site solar to power its operations and intends to qualify under Section 45Y. For how many years can the taxpayer receive the credit amount? 1 year, 5 years, 10 years, or none of the above? And then also, I do want to note that many of you are submitting questions for Matt in the Q&A window. We have quite a bit of content to still cover today, and we're running short on time. So if we don't have time to respond during the webcast, we will do our best to follow up with you. All right, here are the results.
Yep, looks like most people, or a plurality, I guess, got the 10 years for the production tax credit. So we talked a little bit about calculating the credit, but you're essentially starting for the ITC at 6% of your CapEx, and really important, obviously, to pay people the correct wages, and that's harder than it sounds. There's a number of particular rules on sort of how and how frequently you have to check to see if you're doing that. But to the extent that that can be done, those wage and apprenticeship rules are met. You're up to 30% sort of base ITC, and then you go to the next slide, which is, well, one thing I'll point out here though is projects less than 1 megawatt at the bottom are exempt from these rules, as are sort of the projects that started construction before the effective date. So if you have a small facility, or you can limit the size of your facility, it may be worth it just not to comply with these rules. We see a lot of 0.99 megawatt facilities. And then the bonus credits, sort of once you satisfy prevailing wage, you're at 30%, then you can go to 40 with domestic content, 50 with the energy communities, 60 with low-income communities, and then up to 70, as we discussed earlier, for qualified low-income and residential building projects. Here's a picture, which I find helpful. And the same for the production tax credit, which has less of an impact because it's percentage rather than percentage points. And another poll question.
All right, thank you. The third question is, a taxpayer is installing a 1.8 megawatt solar project that what credit percentage would they qualify for? 6%,
yeah, so this
30%?
cut out there, but
sorry,
it qualifies for all credit enhancements, so the maximum amounts, right?
Oh, okay. So the max 6, 30, 40, or 70. All right, here are the results.
Yep. So with a solar project, you can actually get up to 70%. So you start with 6, you satisfy wage and apprenticeship, that gets you to 30, and then there's the domestic content goes to 40, energy community goes to 50, and then the qualified low-income building project would be up to 70. So can be quite lucrative. We talked about transferable tax credits. I won't get too much into it. I mean, there's definitely a lot that needs to be addressed. This is a brand new rule where you can sell the tax credits. So there's a lot of uncertainty in the market right now. You know, this is a great way to, we see a lot of companies, you know, you can basically earn a 10% essentially risk-free return that gets paid back, you know, when you file your tax return. So basically save, you know, 10% on your taxes, and you're really doing it in a risk-free or close to risk-free way. So just simple example, you have an ITC asset, it's generating $10 million of credits. This is probably the business that owns the asset probably is creditworthy because it's getting a pretty decent price of 92 cents on the dollar. So it's getting $9.2 million. But then it's got to sort of pay transaction expenses. If there's a tax insurer in the mix, it's got to pay the tax insurance. And so the net to the farm in this case is 8.4 million, which is not too bad if the credits are otherwise can't be used or can only be used way in the future. So sort of a good result there for buyer and seller. And again, the question is, does the passive activity rules apply to the buyer as well? Waiting for guidance on that. Moss Adams actually has been doing state sales of credits for like 15 years. And so I think there's thinking that a lot of this technology that's applying in the state realm is going to also follow in the sort of federal realm. So they use like registration numbers and things like that to make sure that the credits are not being double counted, sort of by the buyer and the seller. But all that stuff is sort of to be determined in regulations. For the most part, C corporation buyers, because of the passive activity rules, you know, generally have large tax liabilities. You know, and then the big question is sort of how risk-free can you make it for the buyer? Generally a guarantee. If not a guarantee from a creditworthy entity, then they will require tax insurance, which is currently in the 3 to 4 cents on the dollar, sort of one-time premium. So it's a $10 million tax credit. You're going to pay $300,000 to $400,000 in tax insurance to sort of satisfy the buyer's requirements. And Amy, I think this is our last polling question.
Yeah, so the last question is, who can buy federal tax credits generated by energy projects? A, anyone. B, corporations. C, individuals. Definitely B, or maybe C. So definitely corporations and maybe individuals. And while you're responding, for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. And then we're also sending them out via email tomorrow, along with a recording of this webcast. A few more seconds here. All right, here you go, Matt.
Yep, that's correct. D, we got another plurality. D is correct. Corporations, as long as they're not closely held, can definitely use them. The question with individuals is, do they sort of get through that passive activity loss rules, at-risk rules, if they're held to apply? I'll breeze through this. This is just for the nonprofits, or if you have a JV partner as a nonprofit. Again, they can sort of get a cash payment in lieu of tax credits. There's some. Here's just a direct ownership example. The NGO just gets a cash payment in the amount of the ITC. Pretty simple. Gets very complicated when you get to JVs. There's a question of, can the cash from the credit be sort of shared? Can the cash sort of be allocated to the tax exempt, and then the credit sort of be allocated to the taxable JV partner? Hopefully the regulations that we expect in the next couple of weeks address some of this, but if it sort of allows for this, I think there'll be a lot of interesting structures that we'll see. And got 3 minutes for questions. How do you want to handle it, Amy? Should I just run through a couple that I see here?
Yeah, if there's some that you can answer quickly, I just pick some of those out. Okay.
Where can we find the IRS rules for qualifying that a project has initiated construction? Check out Notice 2022-61. And that will cross-link to other rules. Can you describe the potential conflicts of using the PTC and the ITC and wanting to claim a carbon utilization? So the question here is, if you have an ITC facility, like an RNG facility, that is generating ITC, can you sort of put on a equipment that also captures the emissions from when you're through that conversion process to get to the renewable natural gas? There are some emissions, and so if you capture those emissions, can you sort of claim both? And I think that you have to be careful there, but I think there is a path there, and I think further guidance should clarify that issue. Another question was part of the debt ceiling debate to limit some of these types of credits. I think to an extent, but I think they were focused mainly on the EV credits rather than these credits, and I think that these credits probably everyone feels are pretty safe for the time being. And then the severe natural resource constraints on electrification of the transport sector. There I think it's more of a lithium issue, a nickel issue, the components of batteries, which obviously are the centerpiece of the sort of electrification sector for transportation. So those things are either extremely limited currently and or in the hands of China. I mean, I think most of the lithium in the world is under Chinese control. So those are the types of issues that I was referring to there. See if there's anything else. Yeah, and ITC can be claimed on the solar and battery storage if they're connected. And these incentives can be available for those that are receiving government grants. You'd have to look at carefully if you're receiving federal grants, you have to look carefully in how you structure these investments to be able to ensure that you can receive the grant without it impacting your ITC amount. So that would sort of be a discussion with your accountant or tax attorney. I think that's all I got.
All right. Well, thank you, Matt, for a really great presentation today. Unfortunately, we are out of time. But to our audience, if you have further questions or comments, please reach out to us and we'd be happy to continue the conversation. You can drop a note in the Q&A window or reach out to Matt directly. His contact information is in your console. And then if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks if you have difficulty downloading it now. And finally, here's a link to a survey for today's presentation. Your feedback is appreciated so we can make the most out of your time with us. And thank you for joining us. Take care, everyone.